from Brian Scott. Jerry Gelke here going to give us a wrap-up on...
Yes, thank you. This is another one of those days where we got another one of those March reports out of the way, and we'll talk about the hogs first. As we expected, at least at Gelke Group here in Chicago, we're looking for less hogs all around for quite some time now, because we were getting information from bankers. They were cutting out capital and telling that they had bled enough equity and that type of thing. And one of the things we did find out through some of the largest hog producers in the nation was that banks were telling their people, to their borrowers in the hog industry, that if you're going to raise hogs, you're going to hedge them off at a profit. And once you're hedged, you probably won't be able to get back out again, because they were so concerned about them losing money. And of course, this is typically what happens at the bottom of the cycle. And it's probably just psychology, but we seem to pull the plug at the bottom sometimes. But at any rate, today the Hogs and Pigs report came out, and as one analyst talked about it, he said, wow, these numbers are significantly under trade guesses, sets the stage for lower than expected production. And if you look at hogs today, they even dropped precipitously today at the last 10 minutes of the day, and even for the week. And we've been short 100% for the last few days. When hogs got higher into the $80 range, and of course there was $25 to $30 a head hedging, so we hedged them. And today, before the market closed, we lifted half of them and sold puts against the other half. And today's report came out 3% under last year, or about almost 2% less than what the average guess was on all hogs and pigs. And kept for farrowing was 96% of last year, about 1.5% less than the average guess, so well under the average guess. And of course, kept for marketing, which means the ones on hand right now, set 97% versus 99% average guess, 97% as compared to 100% last year. So down 3% from last year, down significantly from 2008. So the farmer had been liquidating, and what we saw coming was the liquidation in the gilt retention, or the lack of gilt retention. And the farmers apparently, in trying to outguess what they were thinking, was that they were keeping the old sows back because it's easier financially to breed them one more time, hoping that maybe we'll get a turnaround somewhere, and then they did not keep as many gilts back for breeding. So, and that seemed to be true. And now we're kind of hearing that, and I'm sure what will happen now with the hog prices at least stable to higher, that we'll see the opposite happening. We'll see gilt retention, and maybe even less hogs being slaughtered, and consequently that may create even an artificial supply shortage because of that, and prices go even higher. But all along, some of the hog producers that we have that are in the market that sell, that are not contracting hogs, we're getting a lot higher cash prices for their hogs to fill slaughter levels than what the basic market was paying. So we pretty much had this one pegged for a while, and after quite a few arguments with the USDA, this time we were right. So we're basically going to see how the market trades on Monday, and then likely we will not want to have anything hedged at these levels or lower, thinking that we'll probably go higher. There's a rule that used to be in place, and it says that for every 1% less supply of hogs, there was a corresponding 10% change in price, and that has been real significant. So that 10% in price, certainly when you're at $80, you don't go up $8, but if you're at $60, you probably go up $6. So in the level that we're at, I would suspect that this 1.5% less than average guess could be $8 to $10 possibly, maybe more like 6 to 8 in the short term. So we'll see how it turns out, but certainly we've got a supply shortage and a meat shortage, along with cattle in the same situation where their livestock kept for or the cattle on feed report was down significantly from last year. So we've got a shortage of meat coming due next summer, and if that continues and we accidentally get unemployment to start stabilizing and we get a demand back for this stuff, and maybe even export some hogs and beef, then we could be on a roll to where it's finally time for the livestock industry to make some money. The implications for grains, we were heavily short this market on the turnaround a couple weeks ago, the failures and technically and so forth, and you've seen some of the charts, and we'll update them again this week to show where we're at the end of the week. But we're going to go into this report today basically 100% or over in in hedge coverage for 2009 and even 100% or more in beans for 2010 and almost 100% for corn. This pig report tells us that demand for the first two quarters of this year's marketing year should be reported on Wednesday, which is the stocks report will show possibly more corn on hand than what would otherwise be thought. And so you could probably figure there might be a 50 million to 75 million bushel drop in feed usage, which would add then to stocks. And if my thinking is right, we'll probably find more corn because the corn yield was better. Now we're going back and looking at this unharvested corn again. So there shouldn't be anything in the stocks position to make us friendly corn. If there is any implication at all that there is more corn used because of inefficient feeding and crushing, which means for ethanol productivity of corn because of the test weight and all the toxins and so forth, we should see that in there, and it should be addressed by the USDA. So I see nothing friendly in the stocks report coming. The only thing that's left would be the acres. And our acres in our private survey was not near as high as what other people had thought, and well under 89 million. And we're seeing that across the board, that some of the private analysts are saying maybe the farmer will plant more corn later, but he sure isn't indicating like he's going to now. So depending on how we answered the USDA's questions, we may say, I don't intend to plant as much, but now if you give me the price incentive, which may come by either corn going higher because of the acres aren't there, and beans going lower because the acres are there, we'll make that final decision, I think, going into the end of April and into May, of course, as to whether or not price will give us that incentive. Contrary to last year, we started the year out in the end of February, and we rallied right into the 1st of June. And, of course, we knew we had to have a crop, and we were also competing corn with bean acres because Brazil didn't have a crop. So there was always the incentive as we were planting and being delayed to keep on planting, Jerry, and keep on planting till the end of May and into the 1st of June and beyond. I don't think we're going to see that this year because most farmers are tired of what we saw last year and the $100 an acre drying. So we may have told the government we intend to plant less corn, and ultimately what we do is another matter that we'll find out at the end of June. So there better be a bullish planting intentions report on Wednesday, and I suspect that it'll be neutral to friendly, and likely beans, we could see beans probably on the bearish side. And the technical aspect of the market this week pointed that out because we closed in new low closes for corn for the year. We went sideways for a while, broke some resistance, and then July corn, we really got to get it closed back above 377, and that's pretty hard to do. That's about a 10-cent move. But you could get that on Wednesday in a heartbeat if we only have 1 million acres more corn, because then they're going to that'll offset the hog thing. But by the time we harvest next fall's crop, and we're talking about the new marketing year, we'll have hogs in place again, and we'll be eating more. We'll probably increase the consumption of feed by that time, and hopefully the economy turns around to where people will be eating more meat. In the soft red winter wheat area, that's been a bear market for a long time, and it got worse this week as we closed below last fall's lows, and that's pretty significant wheat because wheat will have to be used as a feed grain. If we don't produce enough corn, then you're going to see the poultry people going to wheat. So I don't look for anything bullish out of the stocks report next Wednesday, and possibly a bullish report for corn in the acres and a bearish report for beans. Culture to look ahead and use the tools that we have, and today later on this weekend we'll post the charts as usual, and there'll be a site for you to click onto, and if you need any more information and want a hard copy of it or something, we'll email it to you, or it'll be on the web. So with that, have a good weekend.